Going to go ahead and get started. My name is Brad Wingler. I'm one of the investment executives at MGO. I may work on your retirement plan. Every plan has an investment executive connected to it. So if I'm not your person, that's okay. We kind of take turns doing these webinars. First of all, appreciate you being here. My colleague Parker Kaysgen is also on the webinar. Parker's just going to manage the chat. So if you have questions as we go throughout the webinar, please feel free to jump in, throw your questions in the chat, and we're happy to answer them. We'll try and do most of the questions at the end, although if there's anything pressing, Parker, you feel free to interrupt me if there's anything pressing in the chat. So I pulled a little bit of an audible. So I changed the presentation last night. I was in the office late yesterday, primarily because I didn't get a lot done yesterday. Because my phone rang off the hook. And I know why my phone was ringing off the hook. It's what's going on in the markets. So we encourage employees to call us. And that's one of the things that we really try to stress with these webinars more than anything else is that we're here to help. So whether it's today or any day throughout the year, please feel free to reach out to us. Yesterday, well, I should say the last couple of weeks have been a little bit concerning to me. And it's primarily because the calls that I'm getting, I think it's mostly people who are getting their statements, looking at their statement. I've actually heard some people refer to their 401k plan as their 201k plan recently. It's not that bad. It's not good, but it's not that bad. But I'm a little bit concerned about the message that I'm hearing from some employees, and that is I'm hearing more employees say, how do I get out? How do I go to cash? How do I go to something that doesn't fluctuate with the markets? I get it. I understand that this is a tough time. So I actually cut a few slides out of the presentation, and I just want to talk a little bit before I actually get into the formal presentation about sort of three different things. One, why is the market down? Two, what should you do about it, if anything? And then three, what's MGO doing about it? Because we do make moves. So why is the market down? First and foremost, one of the things I always try to remind people of is financial markets don't always act particularly rationally. Sometimes they act like toddlers. Some of them may have kids, may have grandchildren. Toddlers often have extreme reactions to situations. Financial markets are very much the same. When they go up, they tend to go up too high. When they go down, they tend to go down too low. And so it's a very important thing to keep in mind when you think about financial markets. So why is the market down? If I had to sum it up in one word, I would say inflation. And here's what I mean by that. There's a lot of, we've sort of had a perfect storm of inflation. It's a negative storm, but a perfect storm of inflation over the course of this year. And what's it from? First and foremost, it's from COVID. So as we all know, the government printed a great deal of money during COVID. I don't mean that as a political statement in any way, shape, or form. But one of the downsides to printing the money, and by the way, the government did have to step in and do some things for people. There would have been some pretty horrific situations for people. So I get that the government had to step in, but at the same time, the government printed a lot of money. And when you print a lot of money, one of the things that causes is inflation, because now you have too many dollars chasing too few goods, which causes prices to go up. So that's one problem that we've had. Second problem was supply chain problems. Again, don't want to discuss the political impacts of that or situations. But there's been some serious supply chain problems that have caused a lack of supply. Again, that's inflationary. Then you have the war in Ukraine. Obviously, a horrific situation when you think about the human rights issues, but it also causes inflation, particularly in terms of energy and food. And those things tend to trickle down into the rest of the economy. And then the next one is China. China, during COVID, each time they have a COVID outbreak, they tend to shut down the country. It's one way to handle the situation, maybe right, maybe wrong, doesn't really matter. But the bottom line is the United States buys a lot of goods from China. Those goods were not being shipped. When those goods weren't being shipped, you had a lower supply, again, inflationary. And then last but not least, the Federal Reserve waited really, really late to raise interest rates. That's one of the ways that the Fed fights inflation is they raise interest rates. They waited really late to raise interest rates, in my opinion. And because of that, we sort of had this runaway inflation. And now the concern is that we may be headed for or even in a recession right now. A couple things to know. First and foremost, all of these things the market is aware of, and that's why the markets have been down. But I think more importantly, you need to keep things in perspective. If you go back just to 2019, the year before COVID, the stock market was up almost 29% in 2019 when you measure it by the S&P 500. In 2020, the market was up about 16%. 2021 was up almost 27%. And so far, year to date, the market's down about 22%. So pretty tough situation. The first half of 2020 or 2022 has been really difficult for a lot of different reasons. Primarily, most people have a diversified portfolio, and we'll talk about that when we get into the webinar. But in a diversified portfolio, you have some stocks and you have some bonds. And the bond portion tends to hold up pretty well, typically, when stocks don't do well. Well, that didn't happen this year. And the reason it didn't happen is because interest rates went up so much. Interest rates rising is bad for bonds. It's also bad for stocks, but really bad for bonds. And so when you look at the first half of 2022, it was the worst bond market in over 40 years. Worst first 6 months of the year in the stock market since the year I was born, which is 1970. I'm not as old as you think I am. So tough situation. Corrections are normal. So declines in the market, if you go back and you look historically at the total stock market, all the way back to 1926, so back before the Great Depression, there's been 96 one-year periods if you measure a year from January 1st to December 31st. So 96 one-year periods. Of those 96 years, 72 have been positive, 24 have been negative. So literally exactly 3 out of 4 have been positive and 1 out of 4 has been negative. And even including the Great Depression, the stock market has averaged an annual gain of 10.2%. So I think you sort of have to keep things in perspective when you think about the financial markets. It's not real pleasant to see what's happened recently, but I think we need to keep things in perspective. So what should you do about it? It's one of the most common questions that I'm getting from participants is, what should I do? The short answer for most people is probably nothing. Unless you're somebody who is really close to retirement or literally just can't sleep at night. It's really causing you so much stress that you just can't handle it anymore. Maybe we should have a discussion. But what I would encourage you to do is, if you're thinking about doing something, call us before you do it. Happy to discuss your individual situation with you and help you kind of keep things in perspective. So the last question that I'll answer, and then we'll get into the actual presentation, is what is MGO doing about it? So we're doing a number of things. So for many of you, MGO actually manages your portfolio. Some of you pick your own investments, and some of you, we manage your portfolios. If we're managing your portfolio, we manage a series of portfolios that go all the way from really conservative to really aggressive. We do make movements in those portfolios. And so late last year, we saw that there was probably going to be inflation on the horizon. And so we made some changes to the portfolios. So a few of the things that we changed. We shortened the maturity of the bonds in the portfolio. And you do that because if interest rates rise, the bonds don't go down as much in price. The other thing we did is, if you look at the stock side, and if you pay attention to your holdings, you'll see that we changed the holdings. And I realize that not everybody does that. But if you look at the holdings, we added a few sectors in your portfolios that typically do well during inflationary environments. So we added energy, we added gold, consumer staples, which is like groceries and toilet paper and things like that you have to use, so there's pricing power there. We overweighted utilities, and we overweighted financials. So those are the things that we tried to, kind of steer those portfolios towards. And the biggest thing we underweighted was technology. And so we had a huge underweight to technology, and that's largely because in an inflationary environment, technology generally doesn't do very well. And so when you look at those overall portfolios, they're all down, right? Everybody's down. But those portfolios have actually outperformed their benchmarks by anywhere from 3 to 5% this year. So down, just not quite down as much as the markets. And then last but not least, recently we have made some more changes. So we've actually taken off some of our overweight to energy. We're still overweight a little bit, and increased our holdings in technology. So we're still underweight technology. But the idea is we are making some moves behind the scenes. We don't try to time the market. I don't think that that's a really good idea. You can be successful at that sometimes in the short term, but in the long term, it's really difficult to be successful at timing the market. So anyway, I just wanted to add a few things to the beginning of the presentation, just because I'm getting a lot of calls, and these are the things that I'm hearing from participants. So I'm going to go ahead and share my screen, and we'll actually start the presentation. Does it look right now, Parker?
Yep.
Okay. So first slide. Oops, how do we advance the slide? Okay, there we go. So some of you may have heard of a gentleman by the name of Benjamin Graham. Benjamin Graham's an economist, a professor, an investor. A lot of people know him as the father of value investing. One of my colleagues, Justin Petrus, some of you may know Justin. Justin's a big fan of Benjamin Graham. He wrote a book back in 1949, still to this day considered one of the best investment books about investments. And it was called The Intelligent Investor. And so if you've ever heard of, many of you may not have heard of Benjamin Graham, but you've probably heard of Warren Buffett. Warren Buffett referred to this as the best book on investments ever written. And one of the quotes that he's attributed with is, successful investing is about managing risk, not avoiding risk, right? So you can't completely avoid risk if you want to make a good return on your money, but you can manage the risk. And one of the ways that you can manage the risk is through a concept called asset allocation, which just means spreading your money out across the number of different types of investments. And that's one of the things that we encourage people to do. And it's one of the things that we do in the portfolios that we manage here at MGO. So what does that mean? And how does that work in practice? So basically what it means is you take all the different types of investments. And if you look at, I always say, look at the red line here, which is international. International gives you some of the best rates of return on the plus side, but it can also give you some of the worst rates of return on the downside. A diversified portfolio, and by the way, this is just an example. This isn't a real portfolio. A diversified portfolio, which is represented by the dark black line, is going to try and smooth out those ups and downs. And what that does is, the idea there is to just try and keep you fully invested so that you don't make bad decisions. And so when you look at various types of investments, a well-diversified portfolio should have a lot of different types of investments in it. Everything from cash, which is capital preservation, all the way up to international. And the idea is the further you are on the lower left, the lower your rates of return, but also the lower your risk. And when it comes to investments, risk presents itself in terms of volatility. So ups and downs of the portfolio. And so a well-diversified portfolio should have some of all of these different types of investments in it. One of the things that you should consider when it comes to investments is your time horizon. I think this is one of the most important things that you should consider when it comes to your investment portfolio. Generally speaking, the longer you have in terms of a time horizon, the more aggressive your investment should be. And the shorter your time horizon, the more aggressive your investment should be. But when it comes to investments, you define time horizon by the point at which It's not when you're going to retire, but it's the point at which you're going to start taking money out of your retirement account. That may or may not be right when you retire. So that's one of the things that we try to consider when we look at individuals' portfolios. The next thing is, I call it your stomach, your risk level. Everybody has different comfort levels when it comes to risk. I have some clients who are very, very aggressive. Some clients who are very, very conservative. I'll give you an example. I have one client who's in her 70s. She's 100% in stocks all the time. She's not concerned about risk. She doesn't necessarily need the money that she has invested in her retirement account. She's fortunate enough to have other assets in other places and other sources of income. The purpose of her money is really, she plans on giving it to her kids. So for her, we invest her portfolio as if it were her kids' portfolio. She doesn't even, most of the time when I ask her how much is in her account, she has no idea. She doesn't pay attention to it. I have another client who can't handle risk at all. In fact, I won't even let him invest in stock funds anymore. I've worked with him long enough to know every time the market goes down, he's going to sell all of his stocks, stock funds, and move to cash. And that's not productive. So I've actually told him, Joe, you're out. Let's just invest in more conservative things and try to make up your money by make your retirement by putting more money in your account, because selling every time the stock market goes down is not productive. So here's where we're going to do something a little bit fun. And this is one of the things that I was not going to do, but changed my mind last night. And that is, I'm going to give all of you a quiz. And so many of you may have taken this quiz when you originally signed up for your 401k plan. This is actually Nationwide's quiz. Some of you many of you are probably participants in Nationwide plans. You may be a participant in a different plan. That's fine. But if you would, and don't put your answers in the chat. This is not a contest to see who can get the highest score. But if you would, take the quiz with me. So the first question, and it's only 6 questions. What is your current age? So for example, I'm 52. So my score on this would be 8. Right? So what is your score on that question? That's a pretty easy one, so I won't leave it there very long. All right. When do you anticipate taking regular cash distributions from your account? Less than 5 years is 2 points. So you're close to retirement. 5 to 9 years is 5 points. 10 to 15 years is 7 points. 15 years or more is 10 points. And that doesn't mean you deplete your account, but when are you going to start taking money? And you may not know the exact answer to that. So if you don't know the exact answer, just the best you can do is fine. All right, so in addition to your current employer-sponsored retirement plan, do you have other retirement plan benefits, such as a defined benefit pension plan or a defined contribution profit sharing plan? So do you have other monies saved somewhere else other than your 401k plan that are earmarked for retirement? So if the answer is no, that's number 1, 0 points. The answer is yes, it's 20 points. And again, the goal here is not necessarily to get the highest score. Question number 4. If you invested $100,000 at the beginning of the year, which example best describes your tolerance towards risk? Remember, the more you're trying to get on the upside, the more you're going to have to tolerate on the downside. So portfolio A gives you an upside of 115,000, downside of 95,000. Portfolio 2 gives you 90,000 to 125,000. Portfolio 3, 100,000 or 85,000 to 140,000. And then portfolio D, I think everybody wants the upside of portfolio D, which is your 100,000 turns into 150,000. But that also means you have a bigger downside. And so which one represents you? Where are you most comfortable? Next one, this is a little wordier one. While riskier than bond investments, stock investments offer the potential for higher long-term investment returns. What is your feeling about investing a portion of your money in stock investments? Again, not a right or wrong answer. One, I'm concerned that stock investments are too risky and would prefer a higher allocation to bonds. In other words, safer investments with lower rates of return. That's one thing. Two, I understand there's an additional risk with stock investments and would consider more balanced approach to stocks and bonds. That's 5 points. Three, I understand there may be some additional risks in stock investing, but the opportunity to achieve long-term growth with higher allocation to equities is worth serious consideration. That's 9 points. And then 4, I understand the risks, but recognize there are growth opportunities in the stock market and would like to maximize those opportunities. So that's 12 points. And then last question. So given the volatility of the capital markets, your account value will fluctuate over time. 3 choices below show potential account value ranges after a 3-year investment period. If you were to invest $50,000, which portfolio would you select? Portfolio 1, where the ranges go between 48,000 to 53,000. That's 2 points. Portfolio 2, your range is somewhere between 45 to 58,000. And portfolio 3, your range is somewhere between 40 to 60,000. That's 10 points. All right, so if you add up your score, you would have, on the top here, you can see that you've scored somewhere between conservative to aggressive. And Nationwide actually provides a chart. For those of you who are picking your own investments, they give you some guidelines as to what you might want to choose. So let's just say somebody scores moderate. According to Nationwide, you should have about 20% in international, 5% in small caps, 7% in mid caps, 28% in large caps, 28% in bonds, and 12% in capital preservation. Now, there's no law that says you have to follow this. However, it is some pretty decent guidance. If you're a person whose portfolio is significantly different than what you scored, we should probably talk. So again, I'll put up our contact information at the end. And if you're one of those people who is significantly off from your allocation, it's probably a good idea for us to kind of sit down and assess your situation. And when I say sit down, we can do it over the phone or via Zoom, whatever's easiest for you. As I mentioned before, there's a big trade-off between risk and return. You can see on the bottom left here, a very low risk portfolio would also probably give you a low expected rate of return. A high risk portfolio, on average, should give you a higher expected rate of return. Most people should be somewhere in between. And the one thing, and the reason why I changed a little bit of the way I did this presentation today was, what I'm noticing is a lot of people, and we find this typically when we have big declines in the market, are not as comfortable with risk as they originally thought they were, right? They didn't think about maybe the downside of the risk. And so what I see is people going from somewhere up here all the way down to the bottom, all the way to cash. That's not particularly productive for you. And so it brings me to a slide that I added. It's one of I like the quote because it makes a lot of sense. It's also one of the most arrogant statements I've ever heard. And it's from a gentleman by the name of John Pierpont Morgan. Those of you, probably not a lot of you know who John Pierpont Morgan is. You probably know him by his more common name, J.P. Morgan. J.P. Morgan said, in bear markets, stocks return to their rightful owners. Unfortunately, oftentimes that's wealthy people and institutions. Now is probably for many people not the time to make emotional decisions about your money. Remember, the stock market has already factored in a lot of the things that have already happened. right? So keep that in mind when you think about your investments. And if you're considering making a decision about your investments, call us before you do it. Let's discuss your situation before you do that. So generally speaking, when you talk about asset allocation, and a number of these slides, I'm going to rush through them just because we're getting close to the half-hour mark here. Generally speaking, the younger a person is, the more they're more aggressive their allocation should be. I always use my daughters as an example. I have 4 children. My daughters in their 20s, their 401k accounts are 100% in stocks. They're far, far from retirement. As you get closer to retirement, you should have more of your investments in bonds. And if you think you're misallocated, we should probably talk about that. Last quote. I like this one a lot. This is from, I'm not sure how to pronounce his name. It's either Daniel Kahneman or Kahneman, but he won the Nobel Prize in 2002 in behavioral economics. And what he said was, I think one of the major results of the psychology of decision making is that people's attitudes and feelings about losses and gains are not symmetric. So we really feel more pain when we lose $10,000 than we feel pleasure when we gain that $10,000. And I think that's very, very accurate. It's also one of the reasons why people sometimes do irrational things when it comes to investments. I actually had this happen yesterday. I believe it was yesterday. It was either yesterday or the day before. I had a woman call me. She said she wanted to move to cash in her 401k account and then get back in after the market recovers. That doesn't make sense, because after the market, that person is selling low and buying high. What I think she actually means, and I think what the issue is her investment strategy is too aggressive for her, clearly. And so what that means is after the market recovers, she probably ought to consider reducing her risk at that point. Again, I talked earlier about stock market declines being normal. So this is just a chart, and this only goes through 2019. And it measures the Standard & Poor's 500, which is just the 500 largest publicly traded companies. When you look at drops in the market of 5% or more, that happens about 3 times every year on average. Like some years it's more, some years it's less. The average length of time that it takes to get from the top to the bottom is about 43 days. Now, a correction, which is defined as a 10% or more decline in the market, happens about once every year on average. And it takes about 112 days to get from top to bottom on average. A 15% decline happens about 1 out of every 4 years, and a 20% decline, also known as a bear market, happens about 1 out of every 6 years. I think one of the most important things to note here is, I think this is one of the things I try to drive home with participants in today's markets, is there's never been a time in history where you had a decline in the stock market and it didn't ultimately go back up and set new highs, even during the Great Depression, right? I even get some people who say, can the market go to zero? Well, theoretically, yes, but all the companies in the stock market would have to go out of business. There's a lot of great companies out there. I don't think Amazon and Apple and Walmart and Johnson & Johnson, I don't think those companies are going out of business. While the fluctuations aren't real comfortable, bear in mind, keep the long term in mind. One of the other questions that I get, and I get this quite often, is should I get out for now and then get back in? My advice is no. And here's the reason. One, I don't think anybody knows when the stock market's going to hit the bottom. And most people that get out never get back in, or when they do get back in, they get in at a higher level than where they got out at. And it's oftentimes when markets recover, they do it pretty violently. They move up very quickly, and most people miss that recovery. And here's the risk of that. This is actually 2010 to 2020, and it's what happened to a $1,000 investment in the S&P 500. So over that period, if you were invested for the entire time, you did really well. And you had some ups and downs along the way. But at the end of the period, you ended up with almost $3,000. So about three times your money. If you had missed the best 10 days, which again, often are the beginning part of the recovery, your $1,000 only turned into $1,642. So you have 45% less. If you missed the best 20 days, you're down to $1,152. If you missed the best 30 days, you actually have a negative rate of return. And if you missed the best 40 days, you actually had a negative 31% rate of return. This is really the reason why we try to discourage people from trying to time the market. So when we talk about bonds, and I realize I'm going pretty quickly, it's in interest of trying to get you back to work or whatever you're doing today. The stock market, part of the reason why you diversify your portfolio with some stocks and some bonds is that typically when stocks go down, bonds hold up pretty well. And you can see that in different periods that happened, since 2010 through 2018. The problem is this year, again, as I mentioned in my opening comments, this year that didn't happen. Bond market and stock market just did not perform well this year. The only thing that did well this year was the two things that did really well are cash and energy. Those are the two things that did really, really well this year. So the best advice I can give you when it comes to your 401k plan is try to increase your contributions. The biggest risk that you have is not having enough money when you retire. And so the best advice that I can give you is not so much about investing, it's about increasing your investments every year. I always tell people to try and increase your investment by at least 1 or 2%, your salary deferral rate per year until you reach the maximum. If you can get to that point, maybe you never get to that point, but those small increases have a huge positive impact in the end. I always tell people, pick a number that's comfortable when you start, whether that's 3%, 5%, 10%, 20%, whatever that number is. And then pick a day. I don't care if it's your birthday, my birthday, January 1st, Cinco de Mayo, it doesn't matter. Pick a day. Every year on that day, increase your contribution by 1 or 2%. You'll be very happy that you did that. I'll give you a few examples. Susie, age 35, increase your contribution by 1%. She earned $60,000 per year. And when she retired, she had an extra $85,000 for investments or for retirement. In this case, it says vacation. It's your money. You spend it how you want to spend it. Andrew, age 45, did the same. He waited 10 years longer, so he has not as much. He has half as much. It's because of the time value of money. But hey, he's got an extra $43,000. And then Sharon does it when she's age 55. She ends up with almost $17,000 extra, enough to pay for quite a vacation, maybe several vacations. So try to do that. Almost at the end here. We'll get to questions in just a minute. So how can we help? Again, I mentioned if you're managing your own portfolio, if you're picking your own investments, we're happy to help you. So feel free to reach out. I'll put up the contact information. I'm happy to take a second look at your portfolio. Again, remember, I can't monitor your portfolio if you're picking your investments. It's just there's too many of you and not enough of us. But keep in mind that we can manage your account for you. We have a program, we call it Road to Retirement. We have portfolios that run all the way from very conservative to very aggressive. And we're happy to manage your account for you if you're not comfortable managing it yourself. For those of you who either have outside assets or have rolled money out of a 401k plan or have another 401k plan somewhere else, we're happy to help you with those. We have another program called Road to Wealth, where we manage all different types of investment accounts. And we can also do comprehensive financial planning. So if you're getting close to retirement, thinking about, hey, I need to look at my overall situation, we can definitely help you there. So at this point, we'll turn it over for questions. I'll put up the contact information. Ooh. Parker, can you see my contact information?
Yep.
So that's my information, my email address. The phone number is our general phone number. If you have questions and you want to, your best way to communicate is via email. You can email me and I'll forward it. If I'm not your investment executive, I'll forward it to the investment executive who handles your plan, and they'll definitely get back to you. If you're not sure who your investment executive is and you want to just talk about your situation, you can feel free to call us. Our phone number is 216-771-4242. We have a real live person who answers the phone. Her name is Rolanda, and Rolanda will, Ro as we call her, will transfer you to whoever your investment executive is. So with that, I will turn it over to any questions. So we have one question so far. I'm laughing because this was actually our last webinar. When will you do, and when to take Social Security webinar? Yes, we actually did that once. We did that. Our last webinar was actually probably about 3 or 4 months ago. And we did Social Security. We actually had an expert on Social Security from Nationwide on the webinar. He actually delivered the presentation. And we'll keep that in mind. We will do that again. So we will do that. That was one of the webinars that we got probably some of the best feedback on, because especially for people who are retiring, it's one of the best questions, the biggest questions I get as a financial advisor. There is not a recording of that one anymore. I see that question in there, but we will do the webinar again. Somebody asked, the person who asked that question asked if there's a recording of that. The recording expires after a while, but we will do it again. Next question is, when would you move back into tech stocks? So we've gradually been moving back into tech stocks. We actually discussed that at our most recent investment committee meeting. Our investment committee, Parker and I are both members of the investment committee, but it's not just us who makes those decisions. We discuss it as a committee, and we're actually currently looking at possibly increasing the technology holdings right now. So it's not a all in or all out. It's right now we're underweight. We're gradually reducing that underweight because technology stocks are starting to look really attractive from a valuation standpoint. So they're cheap. I mean, you've got companies like Netflix. I think Netflix was down about 70% from the high. You've got companies like Facebook down over 50% from the high. So tech stocks are starting to look pretty attractive. Can you get the slide presentation? I don't know that we actually send out the slide presentation, although I can check with our compliance person internally. I'm not sure if we're allowed to send you the actual presentation, but we do have a recording that we can send you of the presentation. Any other questions? Got one more down there. This guy was the first person to log in too. Is it practical to consider retiring while the stock market is low, or wait? It's a very good question. It's a question that I get quite often. The short answer, it depends upon the facts and circumstances of your individual situation. So one of the things that we do when I have somebody who is retiring, one of the things that I often do is we'll do a financial plan. We look at your entire overall situation: Social Security, 401k, investments, your retirement income needs, and we'll run illustrations to help figure out, is it feasible for you to retire at this point? Sometimes the answer is yes, and sometimes the answer is no. But the only way to tell is to look at your individual situation. So if you want to do that, there's no charge to do it. Reach out to us and we're happy to discuss your individual situation with you. So with that, I think I went about 10 minutes long, so I apologize. I'll let you guys get back to the rest of your day. We very much appreciate your participation. But again, don't hesitate to reach out if you have any questions. Thanks and have a great day.